Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And today we have a return guest, Arleen Garza. Arleen, welcome back to the podcast.
It's so awesome to be here, Whitney. I always enjoy our conversations, and I know we're all after the same goal, is to learn more about how we can be successful in buying real estate. So
awesome. Well, let's see. We've got Hillcrest at Thousand Oaks, 240 units in San Antonio, Texas. You guys just recently closed that deal. Before we dive in, for listeners who haven't heard your previous episode, tell us a little bit about yourself, your background in real estate, and where you're at today in the multifamily space.
fantastic. Well, I started out in banking and spent 20 years in the corporate world. And then my husband and I decided after 2008, we both kind of left what we were doing. He sold his business and decided to look at multifamily. So it took us a few years. And then in 2012, we bought a 24 unit that we managed ourselves. And then fast forward to today, we've done 30 transactions, about 5,200 units, and just under 690 million in assets under management. We are vertically integrated, so we have our own in-house management company and a team of about 150 employees.
Awesome. Well, congratulations. Well, let's dive into the details here. Hillcrest at Thousand Oaks, 240 units, San Antonio, Texas. When exactly did it close, and what was the purchase price?
It closed a month and a half ago, and I have to refresh. It was $17,100,000 purchase price. It was part of a 2-property portfolio, but I thought it would be fun to just spend time looking at one of the properties. It is located in the north central submarket of San Antonio, which is also the #1 rent growth submarket in all of Texas. So that's always something we look for. It is close to 4 other of our assets here in San Antonio, so that made a lot of sense. And there's always a story. Why were they selling? This seller had 2 assets. They had completed their business plan, and they were ready to sell. And they bought it in 2016, so they were still going to make good money by selling, even though we bought it at a over 20% discount. So it made sense for us, and it's in a submarket that we'd bought before, and we know we've had success there. So it was somewhat of a wash, rinse, repeat with the little interesting things thrown in. So that is Hillcrest.
Awesome. So when you purchased this property, was it completely turnkey? Was it a value add strategy? I mean, you got it at a discount. So was there deferred maintenance, CapEx that you wanted to tackle here?
It had value add, which is what we like to specialize in. The previous owner had done some work on the interiors of the units, but really had left the exterior alone. So the $1.5 million that we allocated for the renovation budget is split about half on the exterior, half on the interior. And so it's going to allow us to do some really pretty cool things. It did not have a dog park, and we have put a dog park in every single property we've bought. One, because we feel like pet owners are great renters, and they also give us that income from pet rent. So dog parks are important to us. And in addition to that, it already had a fitness center. It had a swimming pool, which in Texas is a must, and had great live oak trees, huge live oak trees that really gave it a great presence. And it's on a street that's heavily trafficked. So every day there's 15 to 20,000 cars that pass directly in front of the property. That means we don't have to spend as much on advertising because people will see it every day.
A lot of value add there. Well, let's get to the offer. What was it on the market for? And was it a competitive listing? Was it listed with a broker? Was it a pocket listing? Tell us a little bit how you got it under contract.
Sure. So it's a broker that we have purchased 5 other properties from, so he knows us very well. And he was asked to bring, his top 5 buyers to the table to look at these assets. And so he came to us and said, "This is right up your alley." So we started working with him. We love him because he's a CBRE broker and he's very straightforward with us, which we like. And it was one very much of the seller really has some debt that he wants to get out of. And he's achieved his business plan. And so that's part of what allowed us to get a good deal was it was time for him to sell. He didn't want to hold any longer. And so it was a great opportunity, pretty much off market. So we're seeing a mix of both of those off and on market, but we're seeing really the last 7 transactions have been from 20 to 30% below the previous prices that had been, in the market. So we loved it. It was an opportunity.
Awesome. So how did you structure your offer in order to get signed?
Okay, so we basically we did have hard money, which in today's market you're hearing less hard money, and it was not as much as we had done, call it 2 years ago, but it was enough that the seller felt like we were going to be serious about closing the transaction. So we had a little bit of hard money on the front end, and then we had some additional hard money after due diligence was complete. We felt like that allowed us to kind of get past any risky part where we might have discovered something that would make us concerned. In this case, we didn't. It's, the typical deferred maintenance. The pool needed a little bit of work and, the landscaping needed to be done, but there was nothing, roofs or foundation, none of that would have caused us concern. But we protected ourselves by doing the additional hard money on the after DD. And we asked for a 90-day close because in today's market, you don't know how long it's going to take the lender, and you don't know, if the capital is going to come in slower. And so we structured it that way, and we were able to close it on time based on the terms. And our investors were excited about it, specifically because we already had experience in the submarket with other assets.
So how long did you have for due diligence?
30 days, the standard 30 days. Yeah, we did not ask for early, an early look because again, this is where we're headquartered. And so we know a lot about that property, and some of our team had actually managed it in their previous life. And so we had a lot of intel on the property. So 30 days was
very
good.
cool. Awesome. Okay, so 30 days due diligence, no early look. Did you walk any of the units before putting it under contract?
Just the standard, lease model units and an unrenovated and then a renovated unit. We always walk the entire property, but we don't necessarily see more than a few units just on our tour. And then, of course, when we do DD, we walk every single unit. So we make sure during that process that every unit gets walked.
Okay. So now you got the property under contract, you're going through your due diligence, tell us about that timeline. Who did you get on site? It sounds like you walked every unit, how long did that take you? Let's go through the physical due diligence here.
Sure. So typically within a week of being under contract, we like to be on site. Our team does the due diligence walks, just because, again, we own our own management company. It makes sense for them to be there. And we use a interesting software that's a phone app based software. So as they're walking every unit, they can basically indicate if the appliances are good, if the flooring is good, what type they are, color, everything can be logged into the app. And so when they're done, we get a nice report without having to take handwritten forms and put them on another document and spit out a report. So that's one piece that we do. And usually within 2 days, we're able to walk every single unit. Now our capital projects manager, Victor, will be there with vendors He will have somebody camera the sewer lines, foundation company check out the foundation, a company check out the roofs. And then while they're there, we already know what we want to do. So he's actually getting bids. He's actually getting them to write out in not completely formal, but just to give him an idea of what it's going to cost to do all of the things that we have in our business plan. And so when DD is over, we know, did we allocate enough money? Did we allocate too much money? Would we shift dollars from one bucket to another based on our due diligence inspection and what the vendor bids came in at? So our sign company is usually there, and they're measuring for new signs if we're going to rebrand. And in this case, we weren't rebranding, but the signage was not appealing. And being on this heavily trafficked road, you want your signs to grab people's attention. So the sign company is there, and typically all their work happens during DD. And when we show up to take over the property, they install signs that day, new signs that day. So we like to be ready for takeover.
Awesome. So did anything come up on due diligence that surprised you or that you hadn't allocated for?
No, I think the only thing, we looked at were the sewer lines, and we always allocate some dollars for kind of a miscellaneous category. And there was nothing wrong with them. There were no holes in them, anything like that. There were a couple of them that had what you call a belly. There were small bellies where the pipe itself kind of gets a little belly on the bottom end of it. Sometimes it's tree roots, sometimes it's other things that cause that. But we determined through our vendor that it was going to be a very small cost to hydrojet all of that out. And so we felt like we were good at that point with that. I will say that we discovered that there was a pending claim on the insurance side. It was a slip and fall from a tenant of the seller. And so we just wanted to make sure that that claim was resolved before closing and that it wasn't going to attach to the property. So when you're looking at properties, you also want to get their loss runs. Their insurance company will tell you if they've paid out any claims for the seller. And you just want to be careful with that because it might affect your insurance price.
Great advice. Well, let's talk about the financial due diligence. Okay, it sounds like physical due diligence, not a whole lot of surprises here, at least ones that couldn't be overcome. What about physical due diligence? Or I'm sorry, financial due diligence.
Financial due diligence, of course. Well, we in today's world, we'll of course get the rent roll and the financial statements for 12 months. But today we're also looking at accounts receivable reports and delinquency reports because you want to see what kind of condition the cash flow is in, right? We're buying cash flow when we buy a property. And so we were more frequent this time. And actually the lender was requesting more reporting than they ever have. And I think it's just a factor of the economy, the market. And we've done 26 loans with this lender, so they know us very well, but they were really more diligent than we've ever seen them on these two properties and then a subsequent property. And it was explained to us that there's not as much deal volume right now. So lenders have more time to dig in. And so they said, don't be offended. It has nothing to do with you. They're just doing a little more thorough look at the property. And so that was something we did. And just answering questions along the way, which then we have to go back to the broker to go to the seller to get that information. Their leases were all digital. So they were all accessible digitally, which can be good and can be a challenge. So in this case, everything wasn't quite as easy to find in what they sent us. And so it took a little longer than we typically take to look at every single lease. But in the end, we got it all done and it was fine. They just weren't very organized in how they kept it all filed in their digital files.
Organization's key, especially when you're trying to sell a property. Well, let's pivot and talk about the financing. Tell us how you found finance the deal. Did you use public, private lending? What was the interest rate? Any prepayment penalties or lockout periods on this?
Great. Yes. So, when we first put it under contract, we were watching rates as we all are doing today. And we went with our tried and true lender, JLL, that we've worked with, as I said, on 26. This made the 26th transaction with them. And so we started walking through the process, and we of course looked at Fannie Mae and Freddie Mac. In today's market, they tend to be the go-tos if your property qualifies for that. 90% occupied for 90 days, et cetera. So we looked at, they sent us a grid of all the different options for, a 5-year, a 7-year, a 10-year with Fannie and Freddie, even some floating rate options, which we didn't take a hard look at. And so then we narrowed it down. We ended up doing a 7-year loan with 7 years of interest only payments, which we like because it can be assumed by a new buyer. So it's attractive, right? And then it's a 35-year amortization. So Fannie and Freddie go through different stages, and we just happened to catch a few of the last two that they did on a 35-year amortization, which is great as opposed to 30 because your payments are less. And so you have more cash flow available from after paying debt service. There is a yield maintenance prepayment penalty, but we've built in dollars on the back end of our underwriting. So if there is a prepayment penalty, we've built that in. But we felt like the amortization, the interest only, and the term of the loan more than made up for that. You kind of have trade-offs when you're looking at your loan terms. And we ended up locking it at a 4.785% fixed. Now, it just so happened that treasuries dropped. And we try to get all of our third-party inspections that the lender needs done early. As soon as we're on site, we try to get the lender on site to do those, so that if we want to lock the interest rate, it's our option to do it. We're not having to wait for the lender. So that means the lender has to completely approve the loan, and then we can early rate lock. So we early rate locked the loan, and we did buy down the rate a little bit. So that allowed us to get a 4.785 fixed for 7 years.
Awesome. Well, congratulations on that.
Thank
you guys
you.
raised capital. You're welcome. You guys raised capital.
We did raise capital on this deal, and remember, it was 2 properties we were buying together. So I think the total raise was $27 million. And there was a part of that allocated to Hillcrest and a part of it to the other property that we bought. But we're finding our investors are still investing. The dollar amounts may be a little smaller than they were investing before. If they might have done 250, they might be doing 175 or 200, but they are still investing with us because we've built a good relationship with them. We have not had any capital calls, and we're big on a lot of reserves. So we raise and keep a lot of reserves on the properties to help for some unforeseen situation. And so they like the fact that we're very careful with that. And so it was a nice process with them. We have a webinar. Typically, we send out an executive summary. We do a deep dive on the underwriting, and we give them updates along the way on the due diligence results, submarket information, San Antonio information, if they're not familiar with the market. So every week we have, 2 or 3 emails going out to keep them updated on the transaction.
Well, tell me how you structured this with the limited partners. Did you offer a preferred return? Were there splits, IRR hurdles? We already established there was a 7-year hold timeline, or it could be up to a 7-year hold timeline on this. Just, yeah, kind of clue us in on how you structure this with your limited partner.
Sure, sure. Well, we typically, well, in today's world are underwriting for a 5-year hold, but we look at a 3 to 5 year horizon. On average, we've held our deals 3.5 years. So, but we like to get a longer term loan. You just never know, right? To have insurance, and because it is assumable, somebody else could take it over. So it was worth doing a longer loan. In terms of the returns for the investors, we like to keep it simple. We've tried preferred returns, we've tried different structures, and sometimes we find that investors can get confused. If it's too complicated and they don't understand it, they're not going to invest. So for us, we have 3 classes of investors. Class A has a minimum investment of $75,000 with an 80-20 split, 80 to LPs, 20 to sponsors. The Class B has a $200,000 minimum investment with, an 85-15, 85 to LPs, 15 to the sponsors. And then for $1 million and more, that's Class C, and it's a 90-10 split. So 90 to LPs, 10 to investors. Now, our distributions and any proceeds would be pari passu. So if one group if there is a distribution, every group participates, A, B, and C, in terms of the class of investor. And the same with proceeds. It would be pari passu. So our investors, we've done probably the last 4 or 5 deals with this structure, a similar structure. And 1, they understand it, and 2, they like that they're being rewarded for bigger dollars invested.
Awesome. And what kind of fees did you charge to this deal?
So we had an acquisition fee, 1.5% acquisition fee. And I like to tell folks that that's how we pay our people, right? We've got to have a team to buy these properties. And then we have the standard asset management fee of 2%. And that's because we do have an asset management team on our team that does nothing but asset manage. So it's not just Jacob and I, my husband and I, but it's actually a team of people that we pay to negotiate insurance, negotiate taxes, to watch the monthly data, etc. And then no disposition fee at 0. And then we do have a 0.5% capital event fee if we do a refinance, just because that does take people's time to process all of that paperwork to do a refinance. So those are the fees, and we disclose them very clearly in everything we share with our investors because we want to be very transparent.
Investors love that, don't they?
They do. And I think today they love it even more. Sometimes you see things on Facebook or LinkedIn and people are upset or concerned that they haven't received financials on their investment. And we are on the money every month sending out the information so people can sleep at night knowing that everything's still okay.
Awesome. Well, Arleen, thank you so much for sharing your knowledge and expertise with us here today. I have 2 questions for you left. On this particular transaction, what did you find easy during the process that you thought would be hard? And then what did you find that was a little harder than expected that you thought was going to be easier?
I think the financing was easier than I was anticipating because you're hearing that the capital markets are tighter, that credit is tighter. So I was concerned about, not concerned, I was just didn't know how fast that process would be on the loan side. So I was very pleased with that. And of course, some of that may have to do with our partnership or our relationship with our lender. As they say, dance with the one that brought you to the dance, right? So we are very loyal there. On the hard end, I would have to say, or the more concerning end, is not being sure how fast you would be able to raise the dollars. And so I think that one worked out just fine, but it was something in the beginning, just didn't know what was going to happen. But I've been that way with every transaction I've done. You always have that little bit of thing in your stomach where you're like, I got to raise this money, how easy or, how fast can that be? So
Are we going to get this one over the finish line? I totally understand that.
Yes, yes.
Awesome. Well, Arleen, again, thank you. If people want to learn more about you, how can they do so?
They can reach out by going to invest at reapequity.com, and that's REEP equity.com. And we have some great tools on there too. If people are getting started, we have a guide for multifamily real estate investing. We have white papers, podcasts, all sorts of information, because we believe people should educate themselves on what a multifamily investment is.
Excellent. Well, again, Arleen, thank you so much for your time and expertise. We look forward to hearing about your future deals.
Thank you for having me. It's always a pleasure. Thank you.